Hey everyone, my name's Andy. My channel is Finding Value Finance. I've got Scott with me again. We're going back and forth. He's going to do a lot of videos on the channel apparently because we like doing this stuff, going back and forth. So we are going to talk about the inverted yield curve. Maybe perhaps why it doesn't even matter. Does it matter? Why is everybody making such a big fuss about the inverted yield curve? And maybe we had some other videos that we talked about other leading indicators that we think are more useful than this. But what's your opinion, Scott, on the inverted yield curve, or the curve inverting, the 2-year and the 10-year?
Yeah, thanks for having me on back on, Andy. Yeah, I don't think it matters too much. I mean, I don't think we need to spend too much time on this because I mean, this shouldn't just be the one indicator that you look for, in my opinion, because it can give you very false signals for a very long time. So, I mean, just look at this Fed chart. So that this is obviously the Fed's, St. Louis Fed's database. If you look at, even if you just go back to 2005, 2000, before a major crash in 2007, 2008, effectively, you've had yield invert back in 2006. So that was like 2 years in advance. So it takes time for this to actually hit the economy. And see this is when they initially inverted. It was a fake out. That was back in 1998. And the markets didn't crash until 2000. So once again, like a 2-3 year warning. And this was, basically a dot-com bubble, which means it was very, very much concentrated in the tech sector. And Dow Jones didn't really take a hard hit back then. Once again, if you look at the 1980s, 1990s, yield curve inverted 1989, March 1989. Once again, it took like 2 years until there was a reaction in the market. So, and this is probably the period that we want to compare it to based on, the huge commodity cycle that we're headed towards. So yield curve inverted here. I mean, I know like big investors like Ray Dalio, for example, he talked about making a huge mistake back in the 1980s, going short. And I remember reading a book saying that he nearly went broke doing it. He had to start all over again because he was going, okay, market's going to crash. But okay, say, for example, let's say you've shorted the market or you're afraid of not investing in commodities back in 1978 because the yield curve was inverting. Look at what would have happened then. So if you look at Dow Jones, did it crash back in the 1980s? No. So, okay. So here's 1978 is the yield is when the yield inverted. If you go to 1978 on this Dow Jones chart, this is pretty much when the inversion happened. So people must have gone, here, it's going to crash, it's going to crash, it's going to crash. But look at what happened. It was just a huge sideways move and boom, you skyrocketed. This was probably the most bullish time in history for the stock market.
Well, so at that time, yeah. And I'm going to give my reason. At that time, yes, we had stocks that were incredibly cheap in relationship to real things. They were one of the cheapest in history. And when you look at this, the yield curve inverts when you have high inflation, at least expectations. Yeah. So you have high inflation, the 2-year goes to the moon because people are selling their bonds. They don't want to hold something that has high inflation because you're going to lose value in that currency and in that bond. And then a 10-year that's way out there, they may think that inflation is going to go away, so it's going to be fine. So the majority of their holdings are going to be fine paying out 6, 7, 8, 9, 10 years out versus the first year or two. But I think if you have bad inflation and you have a housing market that's booming, I would expect the yield curve to invert, signaling that we're in a very bullish commodity bull market. That's kind of my take on it.
That's exactly right. So you've got 1978 here. Like this is probably like the most bullish time for commodities during the 1970s
ever.
Like look at the outperformance of gold to Dow Jones. Like, I mean, that's amazing, right? And this is exactly what you're talking about here, Andy, which is, commodities were overvalued against Dow Jones, against general equities. And this is the time to be rotating back into general equities. So for me, just because the yield curve inverts, it doesn't mean much. You've got to look at a whole lot of other factors that we've discussed in our other video that we've just done, Andy. But yeah, yield curve doesn't mean too much. And I think you've just got to, yeah, you've just got to take into account so many other things when you're looking at the economy outside yield curve.
And the one thing that I would say is we want this yield curve to go massively inverted. Like we want it to be the biggest inverted yield curve ever, where inflation gets
like
bad.
This.
Yes,
This
just like
this
that.
is what we want to see.
We want to see a massive inverted yield curve, and then we watch out when it comes back around and turns back up.
Yeah, 100%. Because this is now, then you're talking about inflationary pressure or inflationary fears, which will drive the commodity prices up. Because then when there are inflationary fears, then people start chasing hard assets like gold, silver, uranium, iron ore, copper, whatever it might be. So,
they're going to say the reason. So what that is basically telling you is that the bondholders are saying, get me out of here, get me into precious metals, get me into commodities, and get me out of here. It's basically another metric.
That's what I think.
Of money rotation.
Yeah. Exactly right, Andy. I completely agree with that.
All right, so we'll keep this one short. We'll nix it there. We just wanted to talk about the inverted yield curve and how we think that it's not necessarily a good indicator of a recession, and that we should not sell all of our stocks, run for the hills, grab our cash, and then hide behind, I don't know, some cabin house or something with our cash. So that's my take on it, at least.
Yeah.
All right, guys. Well, thanks, Scott, for the short clip, and hopefully you guys enjoyed viewing the inverted yield curve from our perspective.
Thanks for having me, Andy.